Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, the YouTubers out there, those watching on the YouTube channel can see I have my sport jacket on today. I am chilled to the bone. You've got a pullover on, David, to keep yourself warm. But you had the nerve recently to send all of us a picture from beautiful, sunny San Diego. You're there with palm trees and beautiful water in the background, in a T-shirt, smiling, while we're just getting buried here with snow and going in the deep freeze. But you did get a little work done while you were out there, right?
I absolutely did. And, it was a group of CPAs and financial advisors that do unique tax planning, some of the stuff that we do here. It's a group that I do a couple conventions with every year. But anyway, it was in beautiful San Diego. And as you mentioned, the weather was a little nicer than it was here. I actually stumbled into a neat little restaurant. I haven't put the picture on there yet, but I just walked from the hotel 2 blocks, and there was a barbecue place with one of the other attendees. We just went in there to grab barbecue. It said Kansas City Barbecue. So I'm thinking, all right, we'll try this. It wasn't Kansas City Barbecue, but nonetheless, it was actually the bar in the first Top Gun movie.
Oh, okay.
And so the actual piano was sitting right over my shoulder that the goose
you break
plays
out,
at
you
it.
Lost that love and feeling.
Anyway, it was interesting. It was a fun little trip. So got some good information and got some good stuff going into 2024. And making sure we are on course to know what we think legislative changes may or may not happen this year.
Well, speaking of staying on course, so the beat goes on back here in Omaha at Retire Smart. We had folks came out for the Social Security classes. We had a successful smart insurance planning round of classes. And you and Kyle Schroeder are going to visit next segment about smart spend down solutions. Now, we rolled this out for the first time in December. Well, we had to book a second class. There was such overwhelming demand. And so we're going to start off that way this time, Saturday, January 27th, 10 a.m. or 1 p.m. That's right here in the Midwest Learning Center at Retire Smart. Real quick, David, what can people expect?
Well, I mean, that class really explains how the Medicaid spend down rules apply. And so that class is really anyone in this audience, doesn't matter what asset level you have. If you have someone in a nursing home and they're spending on their assets, your mom or dad, and you want to learn how you can protect those assets legally, this class would be for you. And it doesn't matter if your mom or dad is going in a home in the next year, next month, or has been in the home already. You may be able to protect a significant amount of assets, and we'll talk a little about that with Kyle coming up.
402-369-7777 if you'd like to join us for Smart Spend Down Solutions. More details in the next segment. In the meantime, David, while you were off gallivanting in the sunshine in San Diego, something exploded in the financial news last week. Bitcoin, ETF, exchange-traded funds. Break down for us what happened last week and what might be happening in the near future.
So the Securities and Exchange Commission, the SEC, not the football conference, right? they actually approved for spot trading in cryptocurrencies like Bitcoin. And so basically Bitcoin, now what's interesting is about a day before it came out, someone hacked the SEC's Twitter or X account and posted that they approved it, and we saw Bitcoin spike about 6%, and then about 20 minutes later, no, the account was hacked, and Bitcoin sold off like 12%, and so somebody made some money there. I'm just saying, because it took, ironically, the government didn't use two-factor authentication on their own account.
Ouch.
Now that's a whole story for another day, but there's your government. So what happened, though, basically about 24 hours, they actually did approve the exchange traded funds, these ETFs that will basically track actual spot price of Bitcoin. And so this now makes it into a legal security. So two things there, Chip. So now it can come under if you buy Bitcoin, it's not a security itself. If you buy an ETF that is tracking or holding Bitcoin, that is a security. So what that means is investment advisors and brokers, those that are licensed to sell securities like we are, can offer these to our clients. Now, we have not yet put any of these in our clients' portfolios or anything like that. There's a lot of hype around it. We are always of the mindset, do your due diligence. So 10 different ETFs were immediately approved, and more will come. Ultimately, though, you're going to end up having maybe 2 or 3 winners, in my opinion, here. Someone will come to the forefront. So big names like BlackRock, Fidelity, Invesco. There's a smaller company called Grayscale, but they've been in that business kind of the longest. The problem is Grayscale's ETF, at least in my humble opinion, is very expensive, more than twice the expense ratio inside of it as to some of the other ones that are out there. So we are actually doing our due diligence because it's probably going to end up in one of our what we call strategic portfolios. This would be a portfolio that would, take advantage of this, be a more aggressive piece. But again, I would caution anyone before they go piling into these type of investments. Do it with moderation. Do not use speculative assets like this long term. Now, Kathy Woods also has one of ARC investments. She's the one, we've kind of bashed her a little bit on some of the things because people pay her a lot of fees and don't even keep up with the things she's chasing. But anyway, this means that cryptocurrency is becoming more mainstream is what it really means. Now, we'll still see what regulatory information the SEC gives out. They've given no information out to investment advisors like us. And so, again, I just tell people, take heed, take caution. But it means it's probably here to stay, Chip. Like some people thought it would just fade away. And the recent passing of Charlie Munger is one of those that didn't think it would be here long term. He'd been on record on that. Well, obviously, this says the other thing. And knowing what we know about government debt right now around the globe, the amount of government debt issuance, this is for a lot of people is a store of value that's different than traditional gold that maybe you and I grew up with as the store of value.
All right. Let's mine that a little bit because precisely for that reason, David, it ain't going away. I'm going to back you up a little bit. Okay. Spot Bitcoin ETF. There are a lot of listeners and clients of ours that I visit with who come through here. Strike one, strike two, strike three. I don't know what an ETF is. I don't know what Bitcoin is. I don't know what a spot transaction is. Can you break down some of the basics for us?
An ETF is what's called an exchange traded fund, ETF, right? It's simply a bundled security that holds underlying securities, right? So you can buy in one ticker, typically three digits long, some are four, and they'll trade on an exchange like the New York Stock Exchange or the NASDAQ, et cetera, the American Stock Exchange, what have you. So you can buy and sell the ETF. They are much more tax efficient than mutual funds. So they're similar to like a mutual fund, right? So that's an ETF. And today's not the day to really go deep dive in that, but we're happy to do that another show. So now let's talk about Bitcoin itself. That's the most common cryptocurrency, even though they're not currencies. That's what everybody references. So that's what I'm using the term. It's a digital asset, okay, that it was created, and no one actually knows who Sakamoto is or whatever his name is. But anyway, we'll have Brad on again to talk about this stuff here coming up. And we actually have a class on this. And again, we'll let you know when the next one of those is scheduled. And then spot price. That's the other thing I want to make sure. This is a spot Bitcoin ETF. It means it's tracking the spot price, Chip, the live price of Bitcoin. So there's things you can invest in that are going to partake in the upside of something. When someone says a spot price of gold, the price of gold right here, right now, right where it is, that instant, that's what you're trying to buy. So how successful these ETFs will be how accurately they actually track the real price of Bitcoin, right? So there's going to be what we call tracking error. So let's say Bitcoin, just simple math, over the next month goes up 10%. Is the ETF up 8% or 9.99%, right? Which one would you want to own? The one that tracks it closer. Now, sure. And so we'll have what's called tracking error, and that'll have to do with how big the expense ratio is and how accurately their underlying assets in the portfolio are. I would imagine that the big behemoths, the Invescos, Fidelities, and BlackRocks that have unlimited checkbooks to do whatever they need to make this work will be the winners long term, at least as I look at it from today. But we'll take a look at that and advise as we see fit. And we'll, any of our clients, we're happy to talk through what it looks like if you put something like this into your portfolio.
Well, and as you noted, one of our financial advisors, Brad Stark, and he is credentialed in digital assets. Yes. And pretty soon we'll let you know when the next digital assets class comes up here at Retire Smart. All right, we'll keep an eye on that issue for you. In the meanwhile, David, the sunshiny, the happy voices were predominating for a while, but I'm going to hit you with two headlines here. One is from the Epic Times. Buckle up for a bumpy 2024, economists say. And this one from CNBC. Global economy set for its worst half-decade of growth in 30 years. That's according to the World Bank. David, this aligns a little more with your view of what the future's going to how the future's going to play out.
Well, you called me out here recently. You said, "Hey, are you Chicken Little or whatever it was?"
The sky is falling.
And in fact, I had to I corrected somebody, actually a client. Why are you so bearish on the stock market? I said, no. I didn't say I was bearish on the stock market. I'm bearish on the economy. There's a big difference there. Now, certainly we think think it means to be prudent and take caution in the stock market, because that's usually a leading indicator and telling us where things are going. And we've seen here the market has struggled to go to all-time highs. It's been up since the beginning of the year. Right at the end of December, it got right back up to close to all-time highs and has not been able to break through. And now we're into earnings season, and all the banks, the big banks, just reported to kick off earnings season, and it wasn't exactly very stellar. The highlight, or at least the one that the stock moved the most, was Citigroup. And why did they move, Chip? Because they fired 15,000 people, right? So Wall Street, of course, in Wall Street fashion, was celebrating that slashing of people's jobs, wrecking their lives and sending them home. But they were like, hey, they're cutting costs, so we'll give them a little bit more on the stock price. And so we're, as I said this last week, Chip, we're going to make that shift here sometime soon, where bad news is no longer good news for the market. Bad news for the economy will become bad news for the market. And when that pivot happens, it happens every cycle, it's violent and it's ugly. And I don't know exactly when it's coming, but I would be prepared for it based on these stories you're talking about. So Jamie Dimon, the CEO of the largest bank we've got here, right? Chase Manhattan, JP Morgan Chase. He's pretty pessimistic on the economy, and he warned people, slow down, you guys are a little ahead of your skis, et cetera. And then we've seen even the really elite go to Davos every year, Switzerland. They just had their little, where they go there and tell us we shouldn't have carbon emissions, but they all fly private jets in there on their own. It's
Right.
You've ever seen the movie The Kingsman? It kind of feels like that. But anyway, they're in there talking about, we're a little worried about our global amount of debt now. What do we do? And so we'll tell you later what they're going to do. But they're laying out plans to tell you how to live your life, but they don't live by the same rules. That's a story for another day as well. But they all see a slowdown in the economy. We see massive protests in Germany right now from all the farmers. They're blocking the roads. They're with the tractors, et cetera, because they're literally trying to confiscate and tell them what they can grow, et cetera. And you're seeing pushback. And again, we'll talk about more in a later section. We're seeing pushback here in America. We just had the Iowa caucus this past week, right? And I mean, we knew Trump was going to do well, but who could predict that he was going to win 98 of 99 counties? He almost won every single county, and he won by more votes than all the other candidates combined. There were 6 other candidates on the ballot, and he waxed them all. I mean, This was an historic performance, and so people need to understand what's happening. There's a rising. It's not Republicans. It's not conservatives. It's not Trumpsters. It's people fed up with the status quo. Government continuing to overspend, and the real person in the economy is not doing well, regardless of what the talking heads on TV are. We see the struggle every day. Just talk to somebody in the grocery store. Interview somebody in the grocery store. When you're walking out there, just ask them, hey, how you feeling about your grocery bill compared to 3 years ago? You can do this. I do it, and you're not going to get a pleasant answer, so just be prepared.
We are in tempestuous, tumultuous times, economically, financially. That's why we have dozens of strategies here at Retire Smart to address all different scenarios. That's the report card. It starts with the report card, the comprehensive review of your financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now's the time to find out. And we'll offer recommendations on what you might want to do going forward. The report card, 402-369-7777. 402-369-7777. Up next, one of our newest classes is Smart Spend Down Solutions. It has proven to be wildly popular. One of the presenters, Kyle Schroeder of Senior Asset Solutions, joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Are you facing the challenge of funding long-term care for yourself or a loved one? Are you worried about doing it without wiping out your assets? You've come to the right place. We have a class coming up on that topic, and one of the presenters is with us today. David, please introduce our special guest.
Thank you, Chip. Yeah, so we've got back in, actually already your second time on here in pretty short order, none other than our resident authority on all things Medicare, Medicaid, nursing home planning, et cetera, Kyle Schroeder. Kyle, thank you for taking time to jump in the studio again this week.
Thanks for having me, David.
Absolutely. So Man, I got to tell you, one, congratulations to being part of the most successful first class we've ever held. You, along with Michael Luna and estate planning attorney Colin Kastrick, held a class. When was that? It was back at the beginning of December. Sorry, I forget the date. But we had over 160 people register and come through for those classes that you guys taught on how to, we call the class Smart Spend Down Solutions. So we're teaching people how to understand how the game works, so to speak, when it comes to if you end up needing nursing home care, whether it's memory care, full-blown nursing care, just assisted living, or even home health care for that matter, you got to spend your own money, obviously, until you get to certain thresholds. And those thresholds vary based on the amount of planning that someone does. And most people, unfortunately, do, as we know, zero planning, right? So talk about one. Let's just talk about the success of that class and some of the people you guys were. You obviously can't give any specifics of people, but just tell us in general some of the things you guys were able to do in the last 2 months of helping folks.
Yeah, the class was very successful. We were actually just going to have one, and so many people signed up, due to fire laws and everything. We had to actually break it down into 2 classes. But we had a good mix of people. A lot of people just wanted to be proactive, and maybe get some long-term care. There's a really neat product called home health care that we've been being able to protect people for about a year in case they need care in-home. But then a lot of people, were in crisis planning mode, which is they need help now. They're draining their assets.
Or a loved one, or mom or dad or something is already in the home, et
Very
cetera,
common, where it was the daughters or sons. Basically they said, are there any options other than spending down? Most people have always told them you have to spend all your money, and then when you have $0 left, then you can qualify. But there's actually things put in place back in 2005 from the government that allows you to compliantly spend those assets down and save them. So.
What I find interesting is as I've gotten educated over the last couple of years on this subject matter, and realized that because of the changes in the law, 19 years ago, basically, you can protect significant amounts of assets. Even if we are in, as you say, crisis mode, we're already spending $6,000, $8,000, $10,000 a month on a facility today, and mom or dad in their name has, maybe $400,000 left in CDs or a little IRA or whatever it is. You can actually go in and protect a pretty good chunk of that, and still qualify to get the government to actually help pay the facility and pay for a quality facility that the parent is already in, the facility they've already chosen, right?
Yep, that's right. And yeah, a lot of people think that the government wants you to lose all your money to the nursing home, but that's just not the case. If you're able to protect your money, you're out there spending that money and stimulating the economy, rather than, if you lose it all to the nursing home, you don't know where that money's going.
Well, you bring up a good point there, is people get upset at the government. I'm certainly one of them, right? And I just wish they'd be better stewards of the dollars that we do give them. This past week was January 15th, so I had my traditional time to write some fat checks that day. And, I kind of get frustrated every time that comes about. But here's the reality. The government, the entire tax code, and the way the rules are written for things like Medicare, Medicaid, Social Security are actually there to incentivize people to take certain actions to get better outcomes and spend more of their own money, in the economy, as you said, because that creates economic activity. That's actually why these rules are written. There's over 1,700 tax incentives in the tax code between the 50 states and the federal government. But most people have no idea how to access those, how to understand it. And again, it's complicated. I'm not saying it's the greatest system, but the system does have incentives built in, and there are incentives built in to help you protect your assets, to help you pass assets on to your family, but you have to plan. And we have folks that come in, I call it the engineer type, that do the research on everything to the nth degree. I've never heard of this. And that's how uncommon it is. And I've got a friend of mine who's a financial advisor that I referred you guys to help a couple of his clients. And he's like, this is real? And he's been in the business for over 20 years and had no idea what we were talking about. And again, you don't know what you don't know. We say it all the time. So because of the popularity, you guys are going to be doing these classes at least, I think, about once a quarter this year. But the first one's coming up here right at the end of the month, right?
Yeah, January 27th. And we're going to basically talk about all these different laws that are in place, solutions that you can take advantage of Just like accountants in the spring, you're trying to save as much on your taxes, and nothing's illegal with that. It's the same way with long-term care planning. There are things put in place, and we're just using the laws to our advantage just to protect. You paid into the system all your life, and these laws are in place for you. And so, we just pass that along, and it's been just quite a reception that we've gotten. One more thing I want to mention, financial advisors. That's who we're reaching out to a lot. And there's financial advisors calling us every day saying, my clients are draining their assets.
And by the way, if you're an advisor, we do have several that listen to this show. There's no problem there. You are welcome to reach out to Kyle, to the folks at SAS, which is called Senior Asset Solutions. That is a completely different entity. They will respect you and your clients and help you understand what it is that is needed to help you plan for your clients. So, and I've trained, as most people know, that, listen, I train advisors all the time. I was just in San Diego doing some training for about 60 advisors and CPAs, and we are happy to help some advisors help their clients protect their loved ones, et cetera, with this valid type of planning, because it's just not well known. Again, financial literacy is not even known within our industry on some of the advanced techniques that you can deploy to help people protect their hard-earned money.
That's right. And a couple examples that we've helped out people with, there was two brothers that came in, and they thought that they were going to lose their home, their childhood home. Mom's about ready to go into care, but because one of the sons has been living there for over a year, she's actually able to gift that home without any penalty. And, they were in tears. They gave a hug at the end of it. And while we were doing some copying, Michael Luna, my partner, was at the copy machine. I said, "Hey, do you guys by chance have Medicare supplements?" And one of them said, "Yeah, I do. I'm paying $3,600 a year." Well, we were able to get down to $1,600 just in that 5 minutes that we were doing some copying.
So about $2,000 savings in addition to saving the family home. That's pretty cool. And that's just it. The solutions. And I was actually in the office this past weekend, early in the morning. And Michael Luna works on the weekends a lot, as I do in the office, and you do too. But you do it because you got a little bit of a travel, so you usually work from home on the weekend. But we were actually having a conversation with just folks that you guys specifically were able to help in the crisis mode from that class in December. He told me you guys are well over $2 million in assets already protected.
Yeah, we're currently working with 10 families to protect over $2 million in assets. And it's just, most of us know somebody in a nursing home. And if you know somebody, have them give us a call. We'll talk to them for 15 minutes, let them know if it's even worth coming in, and then no cost, no obligation. We'll sit down for 2 hours if we need to, just telling you all the options available to you. But you just got to play the game. Otherwise, the game's going to play you.
I can't stress that enough. We stress education, and that's what Kyle just mentioned. Listen, you come in, you can come to the class, where you can just schedule a 15-minute phone call with one of the folks on the SAS team to find out if it's even worth your time to come in, and then they will sit down and they will block up to 2 hours of time, complimentary, to go through every scenario that is possible under the current rules and regulations and laws. Whether you live in Nebraska or one of our surrounding states, they can help you and at least understand what your options are. So that class, again, is coming up January 27th. That's a Saturday morning at 10 a.m. or it's offered again at 1 p.m. You only need to come to one of those. The class runs about an hour to an hour and a half, depending on how much content you guys have time to get through. You guys have really taken the time to really develop a really, really well-founded educational course, and the feedback we got from it was absolutely phenomenal. So thank you, Kyle, for taking time to stop in this week and kind of tell us, is there any tidbits you want to share here with our audience right now? Or
the last thing I just want to leave with you, even if you think it's too late, it's probably not. So if you have money that's being spent on the nursing home, you can stop the bleeding more than likely today.
So whether it's $75,000 you're trying to protect from going to the home in the next 6 months, $750,000 or $7.5 million, there are solutions and plans that can be put in place, and it's not so cookie cutter in this area. So you have to get a devised plan that will actually help you walk you down the timelines of what has to happen and when. But you must take action, or you could be like those brothers, and if they didn't take action and mom would have passed without any pre-done action, that home may have been gone to the debtors. So again, I can't thank you enough for the help you've done with our clients. I'm sure other advisors will be thanking you, and our community will be thanking you. So if you guys want to come for that class, again, January 27th, 10 a.m. or 1 p.m. right here at the Midwest Learning Center, 402-369-7777, 402 369-7777. It is complimentary, but you do have to register. All right, Kyle, we'll talk to you soon and see how this class goes. Thanks for coming by.
Hey, thanks a lot, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about the SMART process. Questioner says, well, I hear you talk a lot about your SMART process. There are a lot of financial planners in this market. Aren't they all pretty smart? What do you mean when you say SMART process?
So there are some intelligent planners in this community, absolutely, bar none. I'm friends with several of them, thank you. But there are some that are unfortunately not as intelligent or as well prepared, especially for retirees, in our humble opinion, because we see their work coming across our desks every day. But what we talk about the SMART process, we're not talking about SMART as in just the word SMART. SMART is an actual acronym for our proprietary planning process. So S stands for sources of income. In retirement, you need to know where your income is going to come from. Obviously, there is no retirement without income, Chip. So it's understanding what sources of income you're going to have available to you in retirement, both what we call guaranteed and non-guaranteed. So guaranteed would be like Social Security or a pension or railroad. Non-guaranteed is going to be stuff from your portfolio, your savings, interest, dividends, et cetera, because those are not guaranteed in any way. So then we're going to move on, and then you have to, by the way, in the guaranteed, we have to have an inflation-adjusted written income plan, and it should take into some what-if scenarios. If you're married, what if one spouse passes away 5 or 6 years in retirement, or what if both of you live 25 or 30 years in retirement? That's a lot of expenses for food, healthcare, et cetera. Have you actually gotten a written plan to show you you're okay income-wise all the way through life expectancy, or at least to age 90, which is the minimum we typically will run these for? But anyway, so that's just the S. The M in SMART stands for medical and healthcare-related expenses. And there's a myriad of these, Chip, and we're not going to have time to get them today, but we just had our guest on, Kyle, talking about part of this, which is, healthcare when you're at the last stages, whether it's receiving care in home or home healthcare. This is also how to make choices for Medicare. If you're able to keep work retirement stuff, if it's TRICARE for life, if you work for the government or the military. We have resident authorities for all this stuff to help you pick the right choices, because your out-of-pocket expenses, according to Fidelity, for a married couple 65 today is reaching $350,000 for the average retiree. That's a lot of money, all right? And we want to plan for it. The A is what we call advanced financial planning, and this is for everything from asset transfers, whether you're a business owner, farm owner, you own rental properties. How do you want to sell assets and pay the minimum tax possible? How do you want to transfer them to your beneficiaries, maybe your favorite charities, whatever it may be? Do you have the basics, the will, the trust, the power of attorneys, all that information? That's all encompassed in the advanced financial planning letter, acronym A. R is very simple. It's for risk management, and then there's a lot more than just market risk. There's opportunity risk, interest rate risk, legislative risk, and we help people understand all the different risks they're going to face in retirement. And then T is my favorite area, as most people know, tax efficient planning. Over 120 tax strategies that we have at our disposal to help clients mitigate, reduce, or eliminate many types of the taxes they're going to face throughout retirement. And we're able to get, Chip, over 38% of our clients on our planning to a tax-free retirement, at least income-wise.
Comprehensive, holistic, you sometimes say, David. That's, to me, what sets apart the SMART process.
Fair question, and thanks for listening, I would say, though. Yeah. And so we probably should cover that a little bit more often. We have so much content we try to fire in the show every week. We should probably slow it down, but I don't know how to do that.
All right, on to the next question. Required minimum distributions. I'm a do-it-yourselfer on retirement. Last year, I started taking RMDs. Now that I've started the process, do I take the same amount every year at the same time?
So that's the scary part about being a do-it-yourselfer. So if you're going to do this yourself, you need to make sure you do the research. And I tell you what, if you email me, we'll send you the actual IRS table that tells you how much you have to take out. It's not the same amount. There are mitigating factors, and these change. The IRS will update these tables, which tells you the percent to take out. So basically the way it works is it works off of life expectancy. The IRS has a mortality table, and when you reach your first RMD age, and there's 4 different qualifying ages right now under current law based on what year you're born. So one, you need to know when to take the first one. It's due April 1st, April Fool's Day. IRS has
Sense of humor
for
there.
the year you hit it. However, you can defer it. So if you turned RMD age last November around Thanksgiving, you could defer that RMD until this April. But we wouldn't have recommended it because you still have to take another RMD this year because you came eligible last year. And so you would have to take 2 in the first year. And a lot of people miss that and end up with a penalty. Now, the good news is the penalties, if you miss, used to be 50%. That's been cut by over half. So the penalties are only about 25% now if you miss an RMD. But that's still ridiculous penalty. Now, the older you get, the shorter your life expectancy. So typically the bigger the RMD, at least a percentage of the account, and it's calculated on your 1231 value. So the year-end value is the value that you would use the divisor to come up with the distribution amount that you have to take. So again, not for the faint of heart. I wouldn't recommend doing this yourself, but it sounds like you are do-it-yourselfer. So if you're going to do it, make sure you have the right access and tools. By the way, there is an RMD calculator right on Charles Schwab's website that you can utilize to make sure you have the right numbers.
Boy, I'll tell you. And we were just talking about the SMART process. It isn't that I question the intelligence of the do-it-yourselfer, but I think of the old adage in the law, the lawyer who represents himself has a fool for a client.
Absolutely. Well, it's like a surgeon trying to give themselves their own heart transplant.
So many
not going to
moving
work too
parts.
good.
So many, yeah. Well, all right. So let's move on then to our next question. This is about business budgeting. David, this comes from my brother Jim, not my brother Tim, who you know, but this is Jim. And he looked at the deal that was done with the big baseball star Shohei Ohtani. So here's the question. The Los Angeles, we're going to look at this from 2 angles, actually. We're going to look at it from the team's perspective here and then from Ohtani's in the next segment. But Jim's question is, the Los Angeles Dodgers are going to pay Shohei Ohtani $2 million a year for 10 years, and then at the end of year 10, pay him a $680 million lump sum. $680 million is double or triple a typical total annual team payroll right now. What business model allows for that kind of massive expenditure for 1 year? Are the owners planning to sell the team? He knows that offering guidance for small businesses is part of what we do here at Retire Smart. So he said, I want to get David Brooks' take on this deal.
So this is a great deal for the Dodgers themselves and for the player. All right.
Okay.
So let's take it from the ownership standpoint first, because that was Jim's question. So number one, it's a business planning for a future liability. However, where are interest rates at right now, Jim? I'll ask you that. Well, you can get guaranteed treasuries up to 10 years right now, yielding just under 5%. And you can actually get contracts from insurance companies at this dollar amount, guaranteeing about 6% for the next 10 years. So if you're the Dodgers, you're not leaving this as an unfunded liability. By the way, anybody that works somewhere, you work at a hospital and you have what's called PTO, paid time off, right? Mm-hmm. If they let you carry that over every year, that is what's called an unfunded liability of the business. Because when you retire, and we do this all the time, people have 60 days of PTO saved up and they get paid out a lump sum check. I do not allow carryover of PTO for my employees. In fact, we just switched, we moved this year to unlimited PTO for our employees. Because number one, if you leave, I don't owe you any PTO, and it actually saves the company money, at least the studies we've done. There was a fiscal reason for doing it, and it's an easier, more flexible benefit for my employees. So, but anyway, that's helping businesses understand how to handle unfunded liabilities. But the Dodgers are not, in this case, unfunding them. The Players Association will not allow them to not have this funded, just so you know. The Dodgers are funding this contract with their current cash flow. They're buying a guaranteed instrument, as I said, most likely at 6% or better return.
So off to the side, they're building a big enough pile of money to cover this.
They're sticking the money in there, and they're making 6%.
Okay.
And then they'll give him the lump sum, but 6% over the next 10 years, they're going to earn about 50% of that contract back just in guaranteed interest. So it's good for the Dodgers, and it's good for the player. Now, why is it good for the player?
Hold that. There's the teaser. teaser. Hold that thought for the next segment.
All right.
Up next. Well, it's kind of funny because actually, before we go, David, let me squeeze this in. How many discovery calls can we take this week?
We have 12 available this week, so now we're back into rhythm. So please take advantage. They do fill up early. 15 minutes on a phone with a licensed advisor. Ask any question you got.
402-369-7777. 402-369-7777. All right, we'll look at it from the player's perspective next. The state of California is not happy about the deal between Shohei Ohtani and the Dodgers and is trying to get the government to intervene. We'll tell you why next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, you set up the cliffhanger there right before we went to the break. So now we're going to look at it from the player's perspective. Here's a CNBC headline. Shohei Ohtani's $700 million contract sparks concern about taxes on deferred income for high earners. State of California is afraid we're not going to get the piece of the action here.
And guess what? He could move. And they could be high and dry on a bunch of this income. The rules and the laws of the land. Again, all people do is play by the rules, which is why nobody wants to play me in Monopoly. I understand the rules of the game, so I win, right? Basically, by the player deferring $68 million a year, he is not receiving the income. Therefore, there's no tax due on it. And that got ruffled feathers of a couple of Los Angeles legislators, right? And so they're upset about city taxes and state taxes not coming into their coffers because they need it so desperately. And he is going to save, now, by my estimates, it's about $180 million he'll save. The article references about $68 million or $98 million, I forget the number, in tax savings by deferring this contract. We think it's going to be depending on if he's smart enough to move before the 10th year, trade away, live somewhere in a tax-free state. When he receives it, he's going to save a ton of money. But
he can play for the Dodgers in L.A. for the next decade, but as long as he relocates before the lump sum comes due.
Yeah, there'll be some tax owed, but it will not be any of the tax that he played on any games outside of the state. He'll still owe the tax on the games played in the state because that's where he earned the income, but they play half their games on the road, right? So and some of those would be in California, but about 35 to 40% of that income will have been played in other states. And if he domiciles in a state that does not collect outside state taxes and is a tax-free state itself when he takes a lump sum, well, he's going to save a chunk of change, 13.3% currently under California law, on about 30% of that contract. And, of course, somebody like me was recommending he might move up to Seattle, which has no income tax. But anyway, so there's a lot to understand here and unpack here. But this is someone following the rules laid out. Right? He's actually doing solid for his teammates because now the Dodgers went out and signed on a signing spree to be able to afford other players so that they can be competitive and not just have, you sign one superstar and then you're done. And the reason he got $700 million, you got to remember, he's a superstar pitcher and a superstar hitter, so it's a 2-for-1.
People are comparing him to the great Babe Ruth from a century ago.
Absolutely.
Yeah.
I mean, he's a phenom he's a really fun guy to watch, too, and he's really humble, and that's what's nice. By the way, when he got there, a player had his jersey number, and the guy gave it to him. There was no financial contract. Sometimes they negotiate. No, you're going to be a lead on our team. You should have...
Just a courtesy. That's class.
So he showed up with a Porsche at his house the next week, handed the player and his wife a couple of cars.
Yes, and don't shed tears for Ohtani. He's not exactly slumming it. He's getting endorsements and other deals. I don't know, the tens of millions. So he's doing all right.
Back to your brother's question earlier.
Yeah.
How do they afford to do this? How would they just plan to sell the team? No, they signed another Japanese superstar. Okay, and I forget his name.
Yeah.
So let me understand. The Dodgers have a unique ability. They're going to make more revenue than any baseball team in history. It used to be the Yankees with their TV network because now they're in Japan and they are embedded in Japan. I mean, they're selling more merchandise on the little island around Tokyo there than they sell all over the United States. They have so much income flow coming in because they have this connection. And the Dodgers have long had a love affair with Asia and vice versa. So they are really smart by how they're going to market this. And not only that, is Shohei's going to get personal appearance money outside the U.S., which if he's smart, he'll leave outside the U.S. and won't pay tax on. And anyway, this will be a contract we'll be talking about for years in business school. It should be because it was brilliantly drafted under the current rules and regs that it's under. So.
Well, you have said numerous times the United States Supreme Court has said it is not only the right, every citizen is encouraged to save as many tax dollars as you can.
Absolutely.
And that's what we saw here. All right. A lot of sports talk this week, David. You sent me a picture of a giant screen. You must have been at a restaurant or someplace, and it's got a whole bunch of graphics. This is from the American Gaming Association about sports gambling. Why did you think that was important enough that you wanted to grab it and bring it into our conversation on the show?
I was actually having lunch with my son, Noah, who works for us here. He does research actually for this show. He gives me tons of stories every week. He's really good at research, and he's concerned about how much gambling is ruining young people, number one. But there's a lot of social media about how it's ruining sports. And there's even, like, if you ask my wife, seems like every NFL game is scripted now. If you notice, I mean, there's just so many terrible referee calls, it seems, as of late.
To
Anyway,
get the desired result.
we're not saying that's happening, but is the influence of gambling changing sports? And sadly, it is, and it's not for the better, right? I'm not a gambler. Okay, I don't gamble. I had to actually go to Vegas this week for a conference, and that's the worst place for me to go. I'll go for a good meal and a show maybe when I'm there, but I just have zero desire to go gamble. Yet they're pushing gambling so hard on our young folks. We talked about Disney pushing gambling into their app. You have these DraftKings and FanDuel and these big conglomerates that are growing so fast, and you can't watch a Sports Center show without them putting just the odds of, hey, you should do this 3-play parlay. People can't afford to gamble are the ones that are gambling, and we're seeing that already evidence right here in Nebraska. Unfortunately, we saw the casino revenue for the first casino that opened up last year, and those are dollars I've talked about are coming right out of our economy from the people that can afford to spend those dollars the least. But just the stats that they show here, Chip, were astonishing. So that's why I just snapped the screenshot, and my son's doing some more research. We'll have that probably in the coming weeks. But basically, sports betting brought in $7.5 billion in revenue in 2022, right? And it was responsible for 12.4% of total gaming revenue. So the casinos, slots, all that. So sports betting, the sports book, as they call it, right?
That's a pretty big bite.
Yeah. So, the first just 3 quarters of 2023, it brought in the same amount of money, and it was a 53% increase from the previous year. Americans bet over $24 billion on sports in just the third quarter last year, Chip. That's almost a 40% increase when people have inflationary problems, their budget's tight. What scares me is how easy it is to access these sites for young folks or people that are desperate to place a bet to try to, leverage and get a return that maybe isn't reasonable, right? And so, unfortunately, it puts people in a spiral in the wrong direction. And of course, we can talk about advocacy for all these things, but I'm just not comfortable with the amount of gambling we have put in front of our young folks every day. It's too easy for them to get access to these things on their apps and what have you. And unfortunately, the media is just pushing the daylights out of it. Wholesome Disney is not so wholesome, in my humble opinion, and they are pushing hard to get your kids exposed to gambling at every single turn through the ESPN, ESPN Plus, ESPN apps, ABC, etc.
Well, there's always been a concern about gambling tainting college sports as well, and of course, we've seen financial.
We can do a whole show on why the NIL deal has already ruined football.
Financial incentives have completely changed the college game. So, yeah, well, that's good. Whatever Noah cranks out, we'll be glad to look at it here on the show. Well, David, in the time we have left, now, I don't know, maybe this is a bit of a guilty pleasure for you. I don't know, but let's look at it. Here is the headline from Fox Business. BlackRock layoffs coming as firm matures, ESG pullback, and Bitcoin ETF approval. There's Bitcoin ETF again. ESG, of course, that's environmental, social, and governance policies. Some would say wokeism. What's going on here at BlackRock?
ESG stands for easily scam, gross up the wages, the revenue for the funds. It's adding on expense and compliance. We've talked about it. Doesn't do any real change. But yeah, so there's so much blowback and pushback from a lot of institutional investors, not only retail investors, but institutional. So pension plans. The state of Florida pulled all their dollars out of BlackRock. Reported on that last year. It was like $480 billion or something they had in BlackRock funds, and they pulled them based on them trying to to force the hand of companies and what they're doing is Larry Fink, who's the CEO of BlackRock, is openly on the mic many times. We're going to make these CEOs do what we tell them to do, and that's not the way it works. The shareholder should be driving that, not the fund owner that happens to own the shares. So they're overstepping their bounds, in my humble opinion. We've had many complaints from clients. We don't want to have BlackRock in our portfolios. We made the adjustment because we got rid of most of BlackRock for our clients, a while back after the complaint. But now they're getting so much blowback, they had to fire about 600 employees that work in this division running that compliance and what have you for ESG and so-called ESG investing. And of course, they were just talking about this kind of stuff, nonsense, in my opinion, unfortunately, over at Davos in Switzerland this week. Again, fly a private jet over there and tell me I can't have a car that puts out any CO2 emissions. But anyway, story for another day. But I do take a little pleasure sometimes when I read BlackRock layoffs. But unfortunately, this is more layoffs, unfortunately, on Powell, and more layoffs. And we've talked about how many of these stories are coming out, and it's going to start to accelerate in this second quarter, I would think, as the job market really, really gets in trouble.
Well, that does it for this week. But before we let you go, I want to remind you one more time. David, there's a phrase that Kyle Schroeder used in the earlier segment of the show with you. This is Spend Down Solutions. This is the class we offer now, how to manage your assets, especially when you're trying to fund things like long-term care. And Kyle said, you better learn to play the game or the game will play you. All right, so join us for Smart Spend Down Solutions, Saturday, January 27th. We're offering it at 10 a.m. or 1 p.m. It's the same class both times, so you pick what's convenient for you, the afternoon or the morning. 10 a.m., 1 p.m., Saturday, January 27th. It's right here at the Midwest Learning Center at Retire Smart. This is like all of our classes. There's no charge, there's no obligation, but we need to know if you are coming. 402-369-7777. 402-369-7777. David, bring us home.
Hey, we've got our annual State of the Market update coming up for just our clients. This is a private event, unfortunately, just for our clients. But if you're a client listening, you haven't registered, please do so because we have to shut the registration off here coming up in a couple of days.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Kyle Schroeder is not a client and was not compensated for his appearance. Senior Asset Solutions is not affiliated with Retire Smart, but is partially owned by David's wife, Melissa Brooks. Furthermore, Senior Asset Solutions is a tenant of and may share clients with Retire Smart.